Yeah, so I joined Morgan Stanley 2003 as an equity on the equities desk. It was a pan-European equity desk in London, and I ended up being on the salesman and talking to a lot of hedge funds. And at that point, I found that most stockbrokers, as I'm sure you know, are always telling you what to buy, and hardly ever telling you what to sell or when to sell it. And so I found a point of differentiation for me as a salesman could be looking at ideas on the short side, what to sell, what isn't going up, and always looking at the bear case of some stocks. And then that evolved into a thematic approach as well. And I realized that there's certain much smaller group of stocks actually that go up over time and contribute to most of the outperformance in the market. Clearly recently they've been FANGs, but you know, it was the Nifty 50 in other parts of the market in years gone by. In 2005, I got asked to join the proprietary trading team, and you have one simple goal there, and that is to make returns for your boss, for Morgan Stanley, with their capital, and not to lose too much money. So when you're a proprietary trader, it's no good saying I only lost 10%, but the market was down 20%. You've still lost 10% of the money. And so the approach always I've used is to try and take the market out of the equation, to try and make absolute returns by looking at themes on both the long and the short side. And then I suppose my real training days came during the GFC, where I saw a lot of people lose a lot of money by being long risky concept stocks and then short the index beneath that. And of course those riskier stocks always went down a lot more than the index, and that's what ended a lot of those books. And me and the team I was in, we always focused on working out what was going to drive the market down. And in Europe in those days, it was, you know, peripheral European banks, for example, some of those Italian, Irish, Spanish banks. And so that's how I developed the thematic approach to looking at groups of stocks and themes of the market that are going both up and down. A part of the training when you learn to be a prop trader is to be, you know, if you change your mind, you need to have that liquidity, which Chris just referred to be able to move fast. You know, if in doubt, kick it out, sort of get rid of things when your conviction falls away. And so in January this year, I mean, one of the themes has been a long theme for us for quite a while, up until the start of this year, was that consumers, particularly millennials, but all consumers, want to spend more money on experiences than goods. You know, you think of your millennial who takes a trip to see a concert, stays in a hotel, posts some photos on Instagram to make their friends jealous. You know, this is all this millennial behavior. Anyway, we were sitting at our desk in sort of late January, and part of the advantage of being a global fund is we do talk to people in Hong Kong and in China and other parts of the world. And some people started to say, you know, there's this disease, this virus coming out of China, and it looks like there'll be some reduced air travel from China. Some of the Chinese airline stocks were already falling in late January. And so it all sort of started happening in slow motion. We'd already been a bit nervous being Australia-based because we'd had the bushfires before that. And at that point we said, look, let's get out of this experiences theme. So we sold our longs in Qantas, a few other kind of travel and experience related stocks. And then as we saw more news flow, cruise ships hoarding, for example, we then decided we shorted airlines, we shorted some cruise line companies in February. We saw the Hong Kong shoppers hoarding their toilet paper. So it didn't happen in Australia or New Zealand first. So we bought Costco, Walmart, Woolworths and Coles as well. And so coming into that sort of March sell-off, we'd seen that a lot of these stocks weren't pricing any kind of risk or very little risk from COVID. And so that's why when March came around, that ended up being the best month the fund has had in terms of performance. The fund was market neutral. There's many longs as shorts, but we were long Walmart and short Carnival Cruises, for example. So that that was the playbook. We covered some actually, again, sort of fortuitously, but there was a weekend sort of in late March when a lot of the press was comparing the COVID crisis to the Great Depression, to a 5 to 10 year kind of event, and that really indicated to us there was potentially maximum fear in the market at that point, and so we did cover some of those shorts. At the moment, we're having a big debate about whether the experiences theme is actually worth playing again on the long side, because you look at post the Spanish flu, post other events, SARS, people do come back and they want to travel and they want to have their experiences again. So, that's part of the thought process we go through. We can be quick to change our mind, but also quick to change it back again, if you like. There probably is a quality bias to the fund. I mean, I don't believe in owning stocks over a 3 to 5 year period that aren't really high quality, and that we have to do the work on those, believe them thematically. There's some stocks we've owned since the portfolio's inception that suit our themes. You mentioned Amazon, we've owned that all along. Netflix, ResMed, some of these, what I call quality big cap stocks. Now, I think a statistic that people don't realize, and something that has been really inspirational to me in believing in market neutral strategies and believing that short selling can generate alpha, not only in the short term, but also in the long term, is that for every stock that goes up by 300% over a 7 or 8 year period, there are 10 stocks that go down by 75% relative to the market. There are actually far more companies that underperform, stocks that underperform the market. If you look at some of the themes we've got on the short side, things like, energy, being short energy in our peak hydrocarbons, being short shopping malls in the Amazon disruption trade, and being short petrol-powered cars in our future mobility theme. These companies are going down and underperforming day after day, year after year against the market. Now, when you've got that short sort of those thematics on, often a lot of these companies, because their margins are falling, they have thin margins. And when the market falls, people become fearful. So I really believe in the greed and fear sort of indexes being really important. When people become fearful, the stocks they're most likely to sell are ones that have a lot of gearing and thin margins. Perhaps they're concept stocks, perhaps they're ones where the management of those companies is quite promotional. And so when the market falls, if you've only got a 2% operating margin, for example, people are going to worry that goes to zero, and the beta of the stock increases. So the market might go down 5%, these stocks might go down 10, then it goes down another 5%, and the stock might go down another 20%, as people think the solvency of the company is coming into question, the business model's coming into question. So when there's fear, the stocks that we've chosen and the themes we've chosen on the short side tend to accelerate in their performance. The rise of ETFs creates opportunities for professional fund managers, well, for investors in general, but it does increase the volatility. When you own an ETF, you don't own the underlying stocks. The ETF buys and sells stocks as money comes in and out. And sometimes it can move those stocks a lot more than they should move. And, an example during recent months, during March, was, the gold mining ETFs sold off about 9% in one night. Somebody was just net sellers of that, even though it was, gold mining companies, which you'd expect to be more defensive. And then we saw a lot of those Australian mid-cap gold stocks get correspondingly sold off 9–10%. The gold price hadn't even moved. So, if you've got the powder and you can take an advantage and buy some of those stocks as they're getting sold off on a lack of liquidity, as Chris pointed out, then there are opportunities. But it also pointed out the inherent riskiness of a lot of those ETF type products.